Welcome to the daily update where I'll go over the action in the market for Tuesday, December 17th, and we'll see how things look for Wednesday, December 18th. Well, I had a down day. The weakness that we've been seeing building going back to last week and even the week before that to a pretty large degree, that just continues. And we were up in Monday's session, down in Tuesday's session, and we pretty much have worked our way back to where we were on a price level from last Friday. So the treadmill continues. Now, we're going to have the Fed coming out in Wednesday's session with their announcement. They're probably going to cut rates 25 basis points or a quarter of a percent. And then what they're going to say after that, maybe the market will have some kind of a reaction. At the same time, we're seeing this weakness, but discretionary growth, mega caps, large caps, they're still holding up. Now, another thing that I'll point out as I go through the charts later on is that we're seeing a convergence, excuse me, we're seeing a convergence of multiple 50-period simple moving averages, not on the S&P, but on other areas of the market. And they kind of all seem to be coming together at the same time right now. That's intermediate term support. And the weakness that we've been seeing is more intermediate term. So we're wondering, are these things going to be able to come together and give us some kind of a bounce up out of that? We'll also be watching those same areas to see if we fall down below them, then things, yeah, are going to turn quite a bit more negative. Okay, we're coming up near the end of 2024 here, but I have a thing called the SPX Investing Program. It's free from now until December 31st, 2024. I will be rolling that over and locking it down. So right now, check it out. There's a link that'll take you to the website as well as to a video. If you have any questions, you can email me. And one of the benefits that you're getting right now is you get immediate access to the videos as they are available. Also, the daily video, that's really what I focus on as far as my day in and day out observation. I do a number of other videos, usually over the weekend, and they're all meant to tie into the daily video. All right, let's go back and talk about what happened and then look at all these charts. We did have a lower open. Now, retail sales came out and it kind of spooked the market a little bit, but the futures were even negative before that. So this just kind of fed into that negative bias. So that lower open, we came all the way down to S2 at 6,047. We declined below the 60/40 level, and then we rebounded back above S2. Then prices chopped sideways. We got up to the 650, 60/50 level, and we just kind of went around there for a while before declining back down to the previous intraday low. So the low that we set right after the open, and we bounced up, came right back down to that intraday low again at 60/40. Then there was some late day buying that took prices back up above S2. Not a real strength, and it was just pretty much the last 30 minutes that did help things. But is that really the smart money coming in and buying it? Usually they are a little bit more aggressive than what we saw. We were down 0.39%. Now, in Monday's session, we were up 0.38%. So we're actually 0.01% lower than where we were last Friday. And we're still above average with volume. So that's staying healthy right now. Now, when you take the short, intermediate, and long term and you use moving averages to determine if we're positive or negative, we're still positive on all time frames. And interest rates are still quite high, and that's been putting pressure on stocks. And of course, that's going to be dealt with in Wednesday's session with the Fed coming in and probably cutting rates and all the crazy stuff going on. Um, yeah, all the drones being spotted in the US, that's freaking everybody out. Of course, you have to wonder, okay, why are they doing the distraction? Why are they not telling people what's really going on here with the drones? Are you trying to have us looking in one direction while something different is going on? You always have to kind of wonder about that when you're dealing with the government, no matter if it's Republican or Democrat. It's just one of those bait and switch kind of things, or, oh, look over here. And okay. But there's all these other geopolitical things going on as well. There's been some escalation talked about in the Baltics between Russia and Germany. Of course, there's the things going on in South Korea. We've got the French election that seems to be dying out of the news right now. And then all the stuff that's going on in the Middle East. But the market really isn't focused on any of that. Some comments, isn't this supposed to be the great time for small caps? Well, maybe not yet. Usually that develops later into the month of December, and they were down. And that's kind of discouraging for folks who just think that small caps are automatically supposed to go up, and here they have been declining. Semiconductors, this is an area I've been really focused on lately because that's such a huge part of the market. We had a good day on Friday, a good day on Monday. Well, we're down 1.6% in Tuesday's session. Now, we have a confirmed Hindenburg Omen, and at the very end, I'll show you that chart. Doesn't necessarily mean that we're going to get a massive decline, but it doesn't mean we won't either. We just use this as one of our indicators to look at, where there's a lot of people out there that they base everything around this. And now a lot of folks, especially the perma bears, they like it when there's just one little Hindenburg omen. There has to be a confirmation spike for that to be taken more serious, especially if we get more spikes after this. And that is a concern, but we don't use this all by itself. We just say, okay, it's here. We'll watch our other charts. We'll see if weakness continues to develop. And this can last for a period of time. So it doesn't mean that things are going to necessarily change right away. On a short-term basis, we're still looking rather extreme right now with the Stochc RSI and the stochastics. And we're still looking pretty good. And this is actually more positive since the Sean trend meter is just kind of drifting at a high level. And then on an oversold basis, and actually the Stochc RSI should be down here at the OS, the oversold or extreme negative reading. We're also dealing with a couple of days now with the McClellan oscillator for the S&P. That's been going down, and that could actually end up being positive because we've been chopping sideways with price. We're seeing kind of an internal correction going on in the market, which could lead to something positive. But if we really start to break lower in the large caps and the mid caps and the mega caps, not the mid caps, large caps, growth, and so forth, if they really start to see some selling, that could take things lower. And we're just treating them as warning signs right now, but we're seeing some positive things as well. But when the McClellan oscillator gets to an extreme negative reading, at some point it will turn and come back up. That could be a pretty good signal. And we're also getting extreme with the PMO studies. No change to the scenario. We'll see what happens. It does look like they're going to come in and cut rates again, 0.25%, and that's almost certain according to what the market thinks. The dollar was up, interest rates were down, and that didn't support stocks all that much. Maybe that added a little bit to the late day buying that came in. We're at 4.38% with the 10-year yield where we had been at 4.41%. But this is higher levels than the market really likes, and that's been pressuring stocks. And we're still uninverted with the 10 to the 3 month and the 10 to the 2. And I'll keep this on her for a while. I'm going to be really happy to make this go away if we go back to being regular again or uninverted here. Because I mentioned this in every video, and it's been 2.5 years, even longer than that in some cases. Sentiment is still positive, even though we ticked down. We had been at 57. Now we came in at 52. So the context is more negative. But since we're coming in at 52, we're looking fairly good there for right now. And the trend is still weakening because we're just chopping sideways now. Now we're positive because the green line's on top, but we're dropping further below the moving average. However, we're still above 20, so it is a trending environment. And with the down day, we're negative. And the momentum, I'm still keeping it mixed because we're just kind of treading along and not really moving right now. So the reports that came out, we had retail sales. Now on the surface, this looks pretty good. It was up 0.7%. They expected it to be up 0.5% as it was last time. This is what's causing some concern. If you take out automobiles, it was up 0.2%. They expected it to be up 0.4%, and last time it was up 0.2%. And the concern is that they don't really seasonally adjust this. It's so that 2% that we're seeing the increase, that's not necessarily showing growth. That's just showing prices are going up because of inflation. And that's why we saw this number going up, and that had the market a little spooked. Industrial production was down 0.1%. They expected it to be up 0.3%. It was down 0.4% last time. Capacity utilization came in at 76.8. They expected 77.3, so this was also weaker and down from the 77% we saw last time there. Business inventories were up 0.1%. They expected them to be up 0.2%. Last time they were unchanged. And the NAHB Housing Market Index came in at 46. They expected 47. Last time we did see 46. Okay, I don't have all the charts of everything, but I do have the major ones here. The core retail sales year over year, just kind of flatlining right now, not really showing an awful lot of growth. And this is one of the concerns, and I'll probably show it in tomorrow's video because Isabel Net publishes a chart about this. That when we see a real leveling off of retail sales, quite often that can happen before we go into a recession. But we've seen that before over the last couple of years, and it has not led to a recession, but we still want to be aware of that. And the month over month, did see an increase. This is the headline number, and that looked pretty solid. Then productivity and capacity utilization. Looking at production here, a little bit below the zero level. We've been dancing along this zero, a little bit above, a little bit below. Now we're going a little bit below, even more, where capacity utilization is kind of flattening out after it had been declining. And then here's another look at capacity utilization based on the percentage basis, where it's coming down a little bit. There's a little less of the capacity that companies have making use of them to actually produce things. Now, this could end up just justifying the Fed coming in and cutting rates again, because these reports are weaker than expected. And so that might say, okay, yeah, we'll go ahead and cut rates. And that might even spark an interest in January that the Fed may come in and cut rates again for that reason. But that's pure speculation on my part. The market has to work that out for January. And that's still, there's so many variables left to deal with between now and then. And then month over month production, it is improving here, but it's still negative. The NAHB Housing Market Index came in with the same reading as what we saw last week, but we are seeing a general improvement overall going back to last summer. Then we look at this once a week. Now, I use the sentiment gauge that's put out by CNN Money. This is a composite where you're looking at overbought, oversold. This is another way of looking at sentiment as well. And we're still getting kind of a high reading, but we're not up at the really high readings that we were seeing earlier on. And then this is one thing that I'm kind of watching this because maybe bad breath isn't a bad thing. And this just shows that after we have a lot of days, like right now, we've had 11, which now you could say 12, or I'm not sure when this chart was actually produced. It's going to be greater than 11 now. But the next month we are usually up on average of 3%, with the median being 2%, and we're up 62.5% of the time. Not a great track record, but we're seeing some pretty healthy gains after that. And then you look out 3 months, 6 months, and then a year later, where the track record turns better the longer out you go. And we actually see a better average with the 3 months than we do with the median here. So, and then down here at the bottom is when you take everything together. So basically, this is the warning sign that I've been seeing for, my gosh, 2 weeks now, maybe even a little longer than that, where some of our internal measures that steady breath are showing some weakness. And then that's not necessarily a bad thing. It just means right now we're not looking very good. But it's not an automatic that we're going to be able to jet higher either. Because these would be all 100% if that was true. And we don't see 100% of that actually happening. But the percentages are in the favor of things going up. And they must be having their Christmas party or something at Isabel Net. We're getting a lot of the same charts over and over again. I just showed this one last week. This shows the country composition with the MSCI, the all world index here. With even in that, you still have the US being 67% of the overall market with this particular index. And then there are ETFs that also tie into this. And then looking here, you got the Magnificent Seven. Let me see, one, two, three, four, five. Yeah, there's seven here. And they're up according to this chart, 50%, where you have the rest of the S&P still not all that bad, being up 20%. And then the S&P by itself is up 28%. And then the rest of the companies, the Marianne and Ginger part, no, Marianne and Professor and Marianne, that's right. They're still up pretty good, but this is why we're seeing a little bit of a disconnect between the really big companies because they've been performing well. And then that started to wear off as we went through the fall. Well, now that's starting to kick in a bit again here, but they're still up 20%, and that's a pretty good return. But would you rather have your portfolio be up 20%, 28%, or 50%? I mean, it's not a real tough decision. You just don't know how things are going to play out at the time you set up your portfolio. All right, then the Bloomberg, these are junk bonds, these are high yield. That's how they changed the name. And then the other high yield, just comparing different indexes along the way, where we have the darker blue, the high yield, and this tends to track the overall stock market here. But these are junk bonds, and they're called junk for a reason because they're usually riskier. And in order to entice investors to come in and buy those bonds, they have to give them a higher yield. And then another index, which is also up, where the corporates, where we're still looking pretty solid. If you go through the intermarket analysis video that I do over the weekend, we're doing okay here, but they're more conservative, so they don't give as high of a return and they haven't performed quite as well. And then these are the forecasts. I'm not going to go through all this stuff because this is going to change on a daily basis here, put out by Deutsche Bank and what they think the rates will be when we get to March 2025, June, September, and then a year from now. So just, I don't know how they calculate all this stuff, but people love forecasts, so they like to latch on to charts like this. And again, I'm not going to read through all this, but which, if any, of the following do you think poses the biggest threat to market stability or instability, depending on how you look at it, in 2025? And then you can select up to three here. Well, we see a really dark line here with a hard landing. And so there are some folks who are concerned. This is what was the concern back a year ago in December of 2023. That's really dropped off, but that was the big concern. What they're worried about now, because of all these talks of tariffs and things like that, is a global trade war. And that's kind of taking over the headlines. But so you look at the lighter blue, that's where people are most concerned right now. The darker blue is what they were seeing a year ago. And then, and I don't know how they calculate this. Um, when something's priced in or not priced in, there's got to be some kind of a calculation to do it, or people just kind of look at things and go, yeah, everything's priced in by now. But they're pricing in three rate cuts in the next year. And then for some reason, they have a chart that's showing that. I didn't spend any time on Twitter right now, but here's the intraday chart. So this looks like a pretty big gap, but we've been in a rather tight range lately, so it's a little bit more exaggerated. We came down and opened right around S2 and then chopped below it and then tried to come back above it, kind of danced along this 60-40 level for a 60-50 level before breaking lower, coming down and kind of retesting this previous low set earlier in the day, which is also testing the low that we set last Friday, but still above the low that was set back on December 10th. And then this is where we saw some buying coming in right late in the day. Not much of a change. Things typically during a Fed day, which is what Wednesday will be, we'll see some gyration at the open and the market might really calm down a little bit. And then the Fed will come out at 2 p.m. Eastern, make their announcement and declare what they've done or haven't done, and then have their press conference and all that. So things might calm down a little bit and then start to gyrate, especially if something that the market is taking is either really good or really bad news ends up happening. So things are really relatively quiet currently. This is still encouraging. See how values just really going down. That's the intraday value chart based on 10 minutes, where the blue line, that's still holding up fairly well. And so this is one of those things under the surface that could potentially at some point turn into a nice advance for the market. When the blue line's going up, that means there's smart money coming in and actually buying these growth areas. And they usually buy things before they happen. And that's why we watch charts like this. That's why we want to do what the smart money's doing, not the big money. We want to do what the smart money is doing. And this is still improving. Going back to the end of November, we're seeing the S&P growth to value ratio intraday. I didn't have all that great of a day on Tuesday, but overall, we have been seeing a really nice advance here. End of day chart growth was down, but it was down less than value for the large caps, down less for the mid caps, and down a little bit more with the small caps. So this is also encouraging here, where you see we're just going down, 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 down with the small caps, where everybody who got into it right here either had to get out because they're back at their break-even point, or they're just like, yeah, here we go, bought right at the top, and now they're seeing nothing but losses. And that's been what we've seen, the pattern over the last year or so. Shoot up, come down, shoot up, come down, shoot up, come down. But under the surface, we see growth really holding up quite well when compared to value for the small caps. We're also seeing that, even though it ticked down here, we're seeing that general strength with mid cap growth to value, even though the index just keeps going down. And S&P growth to value, even with a down day, this is still showing some strength and in an overall uptrend. And as price has been going sideways, we're seeing this improve, and that could turn out to be positive for the S&P. This is also looking good here. When we look at a growth versus value ETF, we're breaking out from the previous high that was set last summer. Discretionary to staples also still looking good here and in an uptrend, showing how discretionary, even though it's been pulling back, staples have been pulling back even more, and that's still keeping this ratio together. Large cap growth didn't set an all-time high. It did in Monday's session, but it was down 0.45% on Tuesday. And this is where the trend, the ADX is picking up this sideways action here, and that's why we're trilling off with the ADX. It's below its moving average and declining, but we're still above 20. We're still positive since the green line's above the red line, but the green line's coming down as the red line's going up. Now, we'll watch this because if we see a cross here and then a strengthening of the trend, that could switch everything over negative. Right now, this is still hanging on to being positive, declining a little bit more in the short term below the moving average, getting close to that 20 level, but the green line's coming down as the red line's coming up. And we are still seeing above average volume. That's when we're above this midpoint here. And this is an oscillator, so it takes more than just one day into account. And I usually don't show these charts because there's so many diamonds on here. It's like, okay, I can't figure out what they're talking about. But these are a lot of different sentiment gauges that we look at. And I put the red box around here, just meaning now the ones that we look at, we're not looking extreme. But there's a lot of other sentiment gauges that are followed that are looking pretty extreme. And I showed this about a week ago, and we were seeing the same basic reading. And we went up with the VIX on a closing basis with the line chart as well as the bar chart. And we're going back up here with the VIX of the VIX, coming back up closer to their moving averages. So we're seeing fear starting to pick up there and the VIX starting to go back up as measured by the MACD. The momentum is that the VIX is going up. Just a couple of days ago, after Friday, we were into the 13 range. Now we're getting up into the high 15 range. So the market's picking up some fear here. But overall, we tend to see the VIX declining during this part of the year. And right now, it's actually going back up. Skew index still giving us a very high reading up in this red area. So the market is anticipating some kind of a big move that has not happened yet. We declined a little bit with this fear gauge, but we went up with this other fear gauge. So again, we're seeing some contradiction here, depending on what you measure sentiment, what instruments you actually use. And we declined a little bit, but when we look at the risk off versus risk off as the large caps and the high beta stocks, which tend to outperform when we're going up, unfortunately, they also underperform on the way down. So they go down faster than the overall market. This has been coming up quite a bit lately, even though it declined a little bit on Tuesday. And we're seeing large caps still, for the most part, still outperforming small caps. Now, if the small caps kick into gear and really start to outperform, we'll see this ratio going down. But we're still, for the time being anyway, seeing this ratio going up, which means the large caps are still outperforming. And we declined here with the equity put call daily chart, and we're still going down with the 5-day chart. And here's the extreme reading with the other 5-day chart. And we're continuing to decline with the 10-day chart. But this is also picking up more fear now. We're really going up with the volatility risk premium. So there's anticipated fear 30 days out from now. And so this really saw a pretty big spike up. All right, still declining with our advanced decline line based on price and volume, but we're still above these moving averages here. But you can see an awful lot of red as we're just not seeing a lot of positive action right now. But the S&P itself is holding up. And that's what I talk about. This could be a type of a sideways correction where a lot of the internal things are seeing some weakness, but the index itself is still holding together. And we're seeing an expansion of the new lows, not as much as what we saw on Monday, but a real contraction of the new highs. So we're still going down with the 5-day and the 10-day moving average. Seeing a little bit of an improvement here, slowly starting to come back up to the moving average with accumulation and distribution, even though the boom indicator here is still declining overall. But this is what we use. It's one of our smart money indicators. So we did tick up just a little bit there. But on the advanced decline ratio chart, both short term and intermediate term, we're still declining with the blue line and the red line. So that's negative. And here's a further breakout. We're below zero based on price and volume with the 19-day advanced decline ratio. Little bit of an improvement here. The histogram is giving us the same reading after Tuesday that we saw after Monday. And the red line is ever so slightly starting to go back up. So this could be showing some signs of improvement, but we want to see this turn and really start to go back up to be more positive. And this could also give us a little bit of an early, not warning sign, but an early indication that maybe there's some strength starting to build under the surface. We're starting to turn back up with the Chaikin oscillator. Now, sometimes this gives us some really good signals, and we've seen them recently here. And so this going up before we're really seeing price going up could end up being positive. But with the vortex, we're still declining with the green line and coming up with the red line. We're positive since the green line's on top, but seeing a lot of weakness here. And we look at the advanced decline line on a cumulative basis for the S&P, or we're declining. We're also declining based on volume. And the S&P is holding up fairly well. That's the bar chart, where the NYSE advanced decline line is really trailing off now. So that's a bit of a negative divergence there. And the cumulative advanced decline line for the NYSE falling a little bit further below the moving average. And then with our regular NYSE advanced decline line also below the moving average. The other NYSE advanced decline line, which is calculated in a slightly different way, also falling further below the moving average. The common stock, based on price and volume, continued to decline. I believe I pointed out that volume had a little bit more intensity than price, but now you can see where price is actually going down faster. We surpassed these previous lows here, where based on price, where we have not surpassed that based on volume. And this we're seeing a gradual deterioration under the surface with our advanced decline line studies. Further declines with the NYSE common stock, S&P mid caps, and small caps. This is longer term, the 10-day average for the S&P of highs minus the lows, that's continuing to decline. Also dropping a little bit further below zero with the broad market measure, the 5-period moving average of highs minus the lows. And keep coming down here with those stocks above their 20-period moving averages that are inside of the S&P. Now we get down to this 20 level, that's going to produce an oversold indication, which sometimes could be positive. So this going down could actually be kind of a positive setup. Here, we're continuing to decline with the 50-day moving average. We're declining with the 100, but we're still above 50. We're also declining and still above 50 with the 200-day moving averages. So just kind of chopping along here with the overall daily chart, but we are above average with volume. We're declining with the 20, 50, and kind of flattening out a little bit with the 200-day moving average study. The Stochh RSI, which I had in the extreme positive slide there, no, it should be extreme negative. We were extreme negative, then we bounced up with Monday's advance. Now we're right back down to being extreme. But this is the only short-term indicator that's looking extreme negative. We are declining, but still above the midpoint with the Williams percent R. The CCI 14 is starting to drop below the midpoint, but not extreme. And we're declining, but still above the midpoint with the CCI 20. So we're not seeing a real uniformity with our short-term indicators. And we're coming down in the short-term stochastic, coming down with the intermediate term, coming down in the long short-term stochastic, but still extreme positive here. The force index is still positive, but it is declining below its midpoint. And we're underneath this, the blue line and the green line here, which this is what we use to measure the condition of the short-term trend based on 20 periods. And we're just kind of chopping along here. The lines have not started to roll over, at least yet. We're still above the 20 period simple and exponential moving averages. So, and who knows? As I've been pointing out in some other videos, we may get to the point where the moving averages, if they keep going up, since we're above these lines, we might actually hit the moving averages from below with the moving averages instead of price necessarily coming down. And we're still slightly above the midpoint with the standard deviations chart, so that's hanging on to being positive. Balance of power starting to cross below zero, so that's turning slightly negative there. Here's the condition of the 50 period moving average, which is intermediate term, still going up with the red line and the blue line, but we're below both of those lines. The longer we stay below these lines, the more we're going to see these roll over, unless we can get back above these lines. And still looking more positive. It's really hard to tell because these things redraw. When they go from darker blue, that's positive, to lighter blue, that's turning more negative. So I guess we're still positive there. Still above the midpoint with our highest high value chart. Still seeing a decline here with the TTM squeeze with the darker blue. Declining, but still above zero with the ease of movement. The Erin indicator has not changed. That's still positive. This is another one, the S&P McClellan oscillator, dropping down below this minus 60 level. And we're wondering, okay, is this going to finally bottom out somewhere and start to turn and go back up? And whenever we're below zero with the McClellan oscillator, we go down with the summation index, excuse me, based on price and volume. And we're further dropping below zero here based on volume. Sorry, having to clear the old throat here. And the NYSE McClellan oscillator also declining, but not getting to that extreme reading. So the summation index for the NYSE declining based on price and volume. This is where we're seeing volume a little bit faster. This line's going down quicker than what we're seeing it on price. Swenlin trading oscillator hasn't really given us any signs of hope yet. We're still declining based on price and volume. We want to see this turn up. Sometimes we get really good signals from this chart, but right now it's just signaling continued weakness. Momentum is now shifting over more negative with the PMO. We're also declining based on price and volume and dropping further below the midpoints. Getting extreme with the PMOs that are rising. The buy signals are declining and also close to extreme. We continue to go down with the PMOs above zero. In the short term, the slope oscillator is now going down. The MACD had already been going down. So in the short and intermediate term, we're seeing some weakness coming back down to the moving average with the TRIX and KST. Those are the longer term oscillators. Topic curve is continuing to be negative. The Sean trend meter coming down a little bit, but we've been hanging out in this green area now for quite some time, suggesting good solid momentum. But even it's showing a little bit of signs of weakness. Starting to drop below 50 with the money flow. So that's turning over negative. The ultimate oscillator was already below 50, but it's back to declining. We're declining, but still above this advancing moving average with unbalanced volume. Still above 50 with the RSI 14 and 9, although they're still showing more weakness here. And we've gone from positive back to neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SER since the dots are on top. Still above all the plotted moving averages here. Bullish percent index continues to decline. That means there's an increase in the sell signals inside of the S&P according to point and figure charts. So this context has been negative and continues to be negative even though we're still above 50. We're declining with the NYSE bullish percent index, and we decline just enough to no longer be extreme positive with the NASDAQ 100 bullish percent index. And since this is going down now, the context is negative. And this is a chart that I hadn't been showing for a while since we've been above all the 20 period moving averages, but this is an open, high, low, close, and then a 20 period simple moving average. Sometimes one of these lines may end up providing support. And we saw that earlier on back in November. Is that going to end up happening this time? And we're still at the high end of this long-term trend channel and having a really hard time breaking above that. And still going sideways for the most part from positive to negative with the Heiken Ashi chart. Now we're turning negative with the Kegi chart. We turned red and we're pointing down, but we're still positive with the Renko chart and we're negative with the three-line break chart. Long term, still declining with our 150 and 200-day moving averages, but still looking pretty solid overall. But they've been giving us very high readings for most of 2024, and those are being worked off now. And I pointed this out yesterday. These signals don't happen very often. This is the Zohor-Chak method, good old solid Midwestern name there, where we had come down earlier, like a month or so ago. We went from 10 down to 8. And then with the bounce up that we were seeing, we went back up to 10. Well, over the weekend, we ended up switching back down to 8. Now, this is still positive, but we want to be aware of this because going from 10 to 8, of course, that's a decline, and that's a bit of a concern to us. Then we're negative with the mid caps and small caps. That hasn't changed, and that's in the short term, where all the other indexes are still positive. We're now negative across the board with commodities in the short, intermediate, and long term. We're still negative with bonds based on price in the short and intermediate term. And there was only one sector that was up, was discretionary, and that's been the stronger performing area going back to August 5th. All the other sectors ended up being down. Lots of red. No Christmas. This is like Valentine's Day here. Just usually when we see red and green, we go with the Christmas look. But we're seeing the materials having a BPI cross below 30. Now that's starting to get oversold there, with the NASDAQ crossing below 20,100. And the financials, and I've been picking this up for over a week now, and I actually have a couple charts to show later on. We're seeing a BPI cross below 80. Now that's been a stronger area, but we've been seeing some weakness now for about a week and a half, and we just want to keep an eye on that area. If this area starts to fall apart, that's a concern to us. We want the financial sector to do well because it was back in 2007 into 2008 when it really started to fall apart, and that led to the great financial crisis. But right now, it's just looking like a normal pullback, but we still want to watch that. And the dollar was up, so the euro crossed below 105, with tech getting a BPI cross below 70 after it had crossed above 70. So we're seeing some weakness coming in right now. And we're also seeing it here. This looks very similar to the NYSE chart that I had earlier with the S&P, with the advanced decline line, where the S&P is holding up itself. The equal weight version, the equal weight version of the S&P is really trailing off and underperforming. And we're seeing that with this ratio. When this goes up, that means the S&P 500 is outperforming the equal weight version of the index as well. Coming right, and this is where I'm starting to see a convergence of 50 of, okay, man. This is where I'm starting to see a convergence of the 50-day moving averages. We're right down to the 50-day moving average with the Dow, but we're still negative with the Elder's Impulse system. And we're a little bit underneath this R2 level with the NASDAQ. Now, this has been a stronger performing area, but it was only down 0.32%. We want to be able to get back above this R2 pivot point. We're still right on the pivot point here with the NASDAQ 100. And we're going from positive to neutral with the QQQs with the Elder's Impulse system, but the momentum for the NASDAQ 100 continues to be positive. Small caps breaking back below this pivot point here and potentially coming down to its 50-day moving average. Another one. Now, we're not there yet, and we don't know if we're actually going to get there, but if we start seeing all these things coming together at the same time, and we're hitting 50-day moving averages, we want to watch that because these are pretty significant areas of support. And if we break through them, then we're going to have to switch and become more negative. And also coming close to the 50-day moving average here. Now, this is the Russell 2000 small caps, where we're declining with the RSI and the momentum is negative. And we're still negative with the Elder's Impulse system for the small caps. And we're right about at the 50-day moving average with the mid caps. So another potential support area coming together at the same time. But for right now, we're still negative with the Elder's Impulse system for the mid caps. Coming down after setting a recent all-time high here with the Wilshire 5000. This is holding up a little bit better, even though it was down 0.5%. Also holding up pretty well here, down 0.52% with the total U.S. stock ETF. This is the bank ETF, also coming down to the 50-day moving average. And see how these things are starting to come together here? And the financial sector coming down close to its 50-day moving average and still seeing a decline where it had been a stronger area. So if we see a lot of these things coming together and then the smart money comes in and starts buying these areas, that could be quite positive. If we hit these areas and we see more selling, that's going to turn things quite a bit more negative. The FANG index, after setting an all-time high on Monday, was down 1.17% on Tuesday. We're still above the shorter-term trend line now. We're wondering if we're going to be able to hold above these higher levels. And I usually show this in the weekend videos, but we're seeing a real deterioration as far as traditional Dow theory, which looks at the Dow and the transports. Then I add utilities to that. That's not necessarily part of traditional Dow theory. But a week ago Friday, we set an all-time high with the Dow, and we've just been going down ever since. The transports, which had been showing some real improvement, are now not looking so good. And the utilities, which had been a stronger part of the market in 2024, they're also showing some weakness as well. And Apple was up almost 1%, setting another new all-time high. So that was helping the market stay together. Amazon was down 0.75% after setting a recent all-time high. Microsoft was up 0.64%. Google was down 0.63% here after setting an all-time high. Meta down 0.77%. And Nvidia dropping further below its 50-day moving average. Tesla just keeps screeching up and up and up here, up 3.64%. This is discretionary, and this is what's also holding up a large part of the S&P 500. Netflix was down 0.21% after recently setting an all-time high there. Seeing more of a short-term disconnect between US and world stocks now, but the longer-term correlation is still showing an improvement. And we're keeping an eye on the semiconductors. This is the SOX index, which is a little different than the ETF that I'll show here in just a moment. We never did get back above the 200-day moving average here, and this is potentially acting as overhead resistance. And we're coming back down to the 50-day moving average after seeing a recent death cross here. That's negative. And after coming back up with the semis to tech ratio, that was giving us some hope here. But we need this to continue to go up to turn more positive, and we ended up declining in Tuesday's session. But then when you look at the SMH semiconductor ETF, we're still holding out a little bit above the 50-day moving average here, and we're still holding out at the high end of the rainbow with that same SMH ETF. So depending on what you look at, support is holding and we're still looking better. But if you look at the SOX index itself, it's looking more negative. That's why we're watching both. The dollar is up and also continues to be in an uptrend. And why is this chart showing up again? The international chart. And here's the dollar. Okay, you're deja vu when you saw that earlier chart. Okay, and then we were down a little bit here with the 10-year bond yield, and we were up a little bit here based on price, even though it has it here is unchanged for the ETF price. This is a concern too. Construction with a ratio to the 3 to 7 year bonds starting to drop below the 250-day moving average. This level held before. If we go back to 2023 and earlier in 2024, we bounced up off of that. Now we could still turn and go back up here, but the fact that we're breaking down below this where we did hold before, that's another warning sign that we're paying attention to. But we're still looking good here with the growth to value ratios. Used to S&P, discretionary, just really looking good. Large cap growth is outperforming large cap value, so we're still looking good with the large caps, mid caps, and small caps. Still going up with the S&P to utilities ratio, so the S&P is outperforming, and that's more positive. And we're still declining here with the staples to S&P ratio. When this goes down, that's more positive for the S&P. So what's our outlook for Wednesday? We will get the Fed announcement at 2 p.m. Eastern time. Not only what are they going to do, but what are they going to say? We're still positive, and we're in this bigger picture look at positive seasonality, but this weakness just keeps growing and growing and growing. Now we're starting to watch some 50-day moving averages as we're seeing a lot of them converge with each other. Is that going to mean something? And we're going to get retail. Okay, I didn't update this. So we'll look at the next chart here. We're going to get the big announcement. That's the big one. We're going to get the MBA mortgage applications index, housing starts and building permits, and then current account balance. But the big thing is going to be the announcement. This is what we're looking at. And all this is FOMC, Federal Open Mouth Committee right here. Then seasonality, we're negative. If you go back the last 21 years, the Dow, the S&P, and the NASDAQ, these are not very good looking percentages for Wednesday's session. And we're seeing a little bit of weak seasonality here, but it doesn't look like it's all that much when you look at the Stock Traders Almanac. I was picking out that we're starting into a time of more positive seasonality, but still quite choppy. And so it's really later on in the month when things tend to look a little bit better. Wednesday in 2023 was the most negative day of the week. It's doing okay so far in 2024. And this is the positive seasonality that hasn't really materialized yet. We're getting up here. Now, even this line is not straight up. So we're still working off some of this weakness that's developing in the market and wondering, is that setting it up for a bounce higher, or are we going to see weakness before we see a further drop? And then this is the S&P provided positive returns in the first year following U.S. elections. This is typically how, no, this is months, not years. And then this is since Trump 2.0, since the election, since he got reelected there. And then Tom Bowley still has us into this more positive time of December, but we've really gone nowhere, both in Monday or Tuesday session when you base it to last Friday. Then this is when historically we see the January effect for small caps. Not happening yet. And then what are the warning signs? We are looking a little better with our smart money indicators, accumulation distribution, but they're still negative. It still hasn't really crossed above the moving average, but the Chaikin money flow is improving, as is the Chaikin oscillator. And we're concerned about the advanced decline lines. We're seeing across the market deterioration as we're falling further below those moving averages. We're still negative and starting to get extreme with the S&P McClellan oscillator and still declining with the NYSE McClellan oscillator, which is sending the summation indexes down based on both of these indexes. And the oscillators are weakening and any more, and we might actually switch over to a more negative stance. The copy curve is back to negative, and now we're looking at the context of the bullish percent indexes, and we're going down with the NYSE and Nasdaq 100, as well as S&P. We do now have a confirmed Hindenburg-Omen, which I'll show you here in just a moment. The parabolic SAR is negative, the Swenlin trading oscillator. The 20 and 50 period moving average study, we could be getting to an extreme reading with those 20 period moving averages. The money flow and the ultimate oscillator are also negative, and they're white because I treat them as secondary indicators. The positive signs, the vortex, but it's not showing an awful lot of strength right now. We're still going down with the 5 and 10-day equity put call ratio charts and growth of value discretionary to staples. This is kind of the positive thing that we're hanging on to, unless you want to bring those 50 period moving averages into the overall mix. And we're still positive, but declining with the 100 and 200-day moving average studies. The ease of movement is still barely positive. The momentum for the NASDAQ 100 is still positive in the financial sector, but we're coming back down, again, getting close to the 50-day moving average. So here's the Hindenburg Omen. If you don't know about that, here's the three criteria that are met. And then stockcharts.com they put all three of the criteria into one chart. And we had our first spike on November 20th, and then we had until the 19th. Now we're seeing a confirmation spike. So we pay a little bit more attention to this. And the more spikes we get, the more we'll pay attention. Because if you look back, we saw a series of spikes, and then we had the COVID crash after that. We saw a series of spikes here, and then this was the end of 2021 before we went into the real difficult 2022. Now, we've had other spikes along the way here, but they didn't really turn into anything. And doesn't mean this is going to turn into anything either. Unless you're a perma bear, you're like, oh, this is done, over. Short everything you've got, sell everything long that you have. But this is just one indicator that we use with all the other ones together. All right, our conclusion. We're still positive when you look at moving averages, and we're still in a period of positive seasonality. It just hasn't started yet. This weakness is continuing to develop, and large caps and growth are really holding the market up, and we're seeing a convergence, as I tried to point out, across a lot of different 50-period moving averages. In the short term, we've just been going sideways. We're like on a treadmill, and there is quite weak seasonality just for Wednesday's session. And we're still seeing this weakness developing and going sideways in the intermediate term. We're still positive, but seeing our longer term moving averages coming down recently. Thank you. I hope you found this helpful, and I hope you have a really good day, and I will talk to you in the next video.